Pull up a chair. Let me tell you about the time Warren Buffett made $8 billion and called himself a duck. It's 1997. The market's on fire. Berkshire Hathaway just gained 34%. Everyone's celebrating. CNBC's doing backflips. And Buffett writes one word in his annual letter to shareholders: quack. You know what's crazy? That single word contains more investment wisdom than most people learn in a lifetime. Because in that moment, with everyone around him acting like geniuses, Buffett's reminding himself and his shareholders of something we desperately need to hear, especially right now, in 2025, with markets near all-time highs and everyone posting their wins on social media. So let's dive into Buffett's 1997 letter and unpack the wisdom of preening ducks, baseball strike zones, and why you should pray for market crashes. This might just save you from your worst investment mistakes. Here's what happened in 1997. The market was absolutely roaring. The S&P 500 was up 33%. Berkshire Hathaway was up 34%, $8 billion in net worth gains. By any measure, that's a spectacular year. But Buffett's sitting there in Omaha, looking at these numbers, and he's not popping champagne. He's thinking about ducks. Picture this: a duck is floating on a pond when suddenly a massive rainstorm hits. Water level rises. The duck rises with it, and the duck thinks to itself, "Wow, my paddling skills are incredible. Look how high I'm floating." But it wasn't the paddling, it was the rain. Buffett writes in his letter, in a bull market, one must avoid the error of the preening duck that quacks boastfully after a torrential rainstorm, thinking that its paddling skills have caused it to rise in the world. Then he adds the kicker: a right-thinking duck would compare itself to other ducks on the pond. So Buffett does exactly that. He looks at the S&P 500. It's up 33%. Berkshire's up 34%. He beat the index by 1%. And here's the part most CEOs would never admit: Berkshire paid $4.2 billion in corporate taxes that year. That's 18% of their entire net worth gone, before they even started competing with the index. Index fund investors? They pay zero taxes at the corporate level. So when you factor in that 18% handicap, Buffett didn't really beat the market. The market's tide lifted his boat just like everyone else's. His self-assessment: quack. That's it. One word. No victory laps. No press releases. Just quack. Buffett writes, our appraisal of 1997's performance, then quack. Now, I want you to think about what's happening in your world right now. Because this duck metaphor, it's not about 1997. It's about every single bull market that's ever existed, including the one we're in right now. You bought some tech stocks in 2023. They doubled. You feel like a genius. But here's the question Buffett's asking. Was it your brilliance, or was it the rainstorm? Did you beat the S&P 500 after taxes? Because if you didn't, you're what Buffett would call a preening duck. And the problem with preening ducks is this: they forget that when the rain stops, the water level falls, and all those paddling skills they thought they had, they disappear real fast. Buffett's teaching us something profound here. It's not about being humble for humility's sake. It's about maintaining an accurate picture of reality. Because when you confuse a rising tide with your own skill, you make catastrophic decisions. You take bigger risks. You lever up. You get cocky. And then the tide goes out. And as Buffett famously said in another letter, you find out who's swimming naked. So before we go any further, let me ask you, are you a preening duck? Or are you comparing yourself to the other ducks on the pond? Now here's where it gets interesting. Because Buffett didn't just avoid being a preening duck in 1997. He did something even harder. He stood there with his bat on his shoulder and refused to swing. Let me explain what that means. 1997 was frustrating for Buffett. Everything was expensive. Businesses were overpriced. Stocks were overpriced. The deals that built Berkshire's fortune, buying See's candies at a bargain, getting the Washington Post for a fraction of its value, those opportunities didn't exist anymore. Most CEOs would panic. Their boards would be screaming, deploy this capital, make acquisitions, do something. And they'd make stupid deals just to look busy. Buffett? He's standing there like a statue, bat on his shoulder, watching pitch after pitch sail by. And he's thinking about Ted Williams. In his letter, Buffett references Ted Williams' book, The Science of Hitting. Williams describes something brilliant. He divided the strike zone into 77 cells, each the size of a baseball, and he figured out that swinging only at balls in his best cell would let him bat for 100. Swinging at balls in his worst spot low and outside would reduce him to 230. In other words, waiting for the fat pitch meant the Hall of Fame. Swinging indiscriminately meant a ticket to the minors. Buffett writes, if they are in the strike zone at all, the business pitches we now see are just catching the lower outside corner. If we swing, we will be locked into low returns. But here's the beautiful part, the part that changes everything about how you should think about investing. In investing, you don't get called out. Ted Williams had to swing. 3 strikes, you're out. But Buffett can watch 100 pitches, 1,000 pitches, 10,000 pitches sail by, and nobody calls him out. There's no umpire in investing. He admits in the letter it's not fun. Just standing there, day after day, with my bat on my shoulder is not my idea of fun. But fun isn't the goal. Making smart decisions is the goal. Now let's talk about you. Right now, 2025, you're looking at the market. Maybe you've got cash sitting in a money market fund earning 5%, and you're feeling pressure. I need to invest this. I'm missing out. Everyone else is buying. That pressure? That's the equivalent of feeling like you have to swing, but you don't. Here's what Buffett's teaching through this metaphor. Define your strike zone before markets open. Ask yourself, what price-to-earnings multiple am I willing to pay? 15, 20, 30? What return on equity do I require? 15%? 20%? What competitive advantage must exist? Network effects? High switching costs? Amount? Write these down. These are your best sells in the strike zone. Now, when you see an investment opportunity, you check. Does it hit all your criteria? All of them? If yes, swing hard. Put serious money to work. If no, even if it's close, even if it's exciting, even if everyone else is buying bat on shoulder, wait for a better pitch. Because here's what most investors forget. The market will serve you thousands of pitches in your investing lifetime. You only need to swing at a few great ones to build wealth. Buffett proved this throughout his career. He didn't buy hundreds of businesses. He bought a handful of extraordinary ones at the right prices. Quality over quantity. Patience over activity. And here's something that's going to sound crazy at first, but stick with me. When that perfect pitch finally comes, when markets are crashing and everyone is panicking, and that wonderful business you've been watching hits your price, you should be happy. Because if you're a long-term investor, you should actually be praying for lower prices. Let me show you why. In his 1997 letter, Buffett gives his shareholders a quiz. I'm going to give it to you now. Question 1. If you plan to eat hamburgers throughout your life, and you're not a cattle producer, should you hope for higher or lower beef prices? Everyone knows the answer: lower. Obviously. Question 2. If you're going to buy a car from time to time, but you're not an auto manufacturer, should you prefer higher or lower car prices? Again, lower. Final exam. If you expect to be a net saver during the next 5 years, meaning you'll be buying stocks, should you hope for a higher or lower stock market? Buffett writes, many investors get this one wrong. They're going to buy stocks for the next 20, 30, 40 years. They're net buyers. Their 401k contributions are going in every month. They're accumulating shares. Yet when the market crashes, they panic. When it soars, they celebrate. Buffett explains, even though they are going to be net buyers of stocks for many years to come, they are elated when stock prices rise and depressed when they fall. In effect, they rejoice because prices have risen for the hamburgers they will soon be buying. This reaction makes no sense. Think about how absurd this is. You're standing in line at the hamburger store. You're going to be buying hamburgers here every week for the next 3 decades. And you're cheering because hamburger prices just doubled. It's insane. But we do this with stocks all the time. Let me show you why this happens and how to fix it. The problem is this. We confuse our identity with our strategy. We call ourselves investors, but we think like traders. We check our portfolio value daily. We feel rich when it's up, poor when it's down. But if you read genuinely accumulating, if you rate a net buyer for years to come, then down markets are your best friend. Buffett reveals something fascinating about Berkshire's shareholder base in this letter. 97% of shares are held by the same people year after year. These aren't traders, they're accumulators. And here's what's brilliant: Berkshire retains all its earnings. Every dollar Coca-Cola pays in dividends, Buffett reinvests. Every profit See's Candies makes, he redeploys. Lower prices mean Berkshire buys more shares at better prices. That means more future wealth for shareholders. So Buffett writes, smile when you read a headline that says investors lose as market falls. Edit it in your mind to disinvestors lose as market falls, but investors gain. Let that sink in for a second. Investors gain when markets fall. He continues, though writers often forget this truism, there is a buyer for every seller, and what hurts one necessarily helps the other. As they say in golf matches, every putt makes someone happy. Now, let's make this concrete for you. Right now, 2025, you're 35 years old. You've got 30 years until retirement. You're putting money into the market every month. The market drops 20%. Normal emotional response: oh no, I'm losing money. This is terrible. Buffett's response would be excellent. Everything's on sale. My dollars are buying more shares. Here's your action plan. Step 1. Define your timeline. Are you a net buyer or a net seller? If you're accumulating for 5+ years, you're a buyer. Step 2. Reframe market drops. A 20% decline isn't a disaster. It's a 30% off sale on future wealth. Step 3. Act on it. When markets drop significantly, don't freeze in fear. Increase your contributions if you can. This is when you should be most aggressive. Step 4. Stop checking prices daily. If you're buying hamburgers for the next 30 years, does today's beef price really matter? What matters is the average price you pay over 3 decades. This is the hardest psychological shift in all of investing. But if you can make it, if you can genuinely want lower prices, you'll outperform 90% of investors. Because while they're panicking and selling, you'll be calmly accumulating at bargain prices. Now, I need to tell you something Buffett admitted in this same letter. Because if you think he's some perfect investing machine who never makes mistakes, you need to hear this story. US Airways. Buffett writes in his letter, those who have watched my moves in this investment know that I have compiled a record that is unblemished by success. Let me translate that. He failed spectacularly. He bought US Airways preferred stock. It tanked. He tried to sell at 50 cents on the dollar. Couldn't even do that. The stress was so bad, he jokes in the letter about his cost for Maalox, the antacid he needed, because this investment was giving him ulcers. Then 2 things happened that coincided with the company's remarkable rebound. Buffett writes, 1. Charlie and I left the board of directors, and 2. Stephen Wolf became CEO. He then adds with characteristic self-deprecation, fortunately for our egos, the second event was the key. The stock went from $4 to $73. And here's what I love about this story. Most investment newsletters, when they're wrong, make excuses. Market manipulation. Unforeseen circumstances. Who could have known Buffett? He puts it in the annual letter, reads it aloud at shareholder meetings, makes jokes about it, then adds, next time I make a big, dumb decision, Berkshire shareholders will know what to do. Phone Mr. Wolf. He's teaching us something here that's bigger than investing. He's teaching us about character. See, everyone makes mistakes. The question is, do you hide them or do you own them? Because here's what I've learned from reading 30 years of Buffett's letters. The mistakes he admits, the ones he puts in writing and shares publicly, those are often his most valuable teachings. The US Airways disaster taught him to stay away from terrible industries, no matter how cheap the stock looks. That lesson probably saved him billions in future mistakes. Buffett concludes this section by writing, it is now almost certain that our US Airways shares will produce a decent profit, that is, if my cost for Maalox is excluded, and the gain could even prove indecent. Even in victory, he's making jokes about his mistakes. So let me ask you, what's your US Airways? What investment are you hiding? What mistake are you ashamed of? Write it down. Own it. Learn from it. Share it with people you trust. Because the moment you stop protecting your ego and start pursuing truth, that's when you actually become a good investor. Buffett's not afraid to look foolish. He's afraid of being foolish without learning from it. There's a big difference. Before I let you go, I want to share one more story from this letter. It's about loss, legacy, and what true focus looks like. Roberto Goizueter, the CEO of Coca-Cola, died in October of 1997. After his death, Buffett went back and read every single letter and note Roberto had sent him over the years. More than 100 of them. Buffett writes, those messages could well serve as a guidebook for success in both business and life. And in one handwritten note, Roberto had written something that perfectly captured his approach to life and work. He told Buffett, by the way, I have told Olgita that what she refers to as an obsession, you call focus. I like your term much better. Roberto's wife thought he was obsessed with Coca-Cola. Buffett called it focus. And Roberto, even in what would be his final months, preferred Buffett's framing. Here's why this matters. The world will misunderstand your commitment. When you're building something that matters, whether it's a business, a portfolio, a skill, a body of work, people will call you obsessed. They'll say you work too much, that you need balance. But there's a difference between obsession and focus. Obsession is compulsive. It's fear-driven. It destroys relationships and health. Focus is intentional. It's purpose-driven. It's a strategic choice about how to spend your finite time on Earth. Roberto Goizueter was focused for 16 years on one thing: creating value for Coca-Cola shareholders. He transformed the company's market value from $4 billion to over $150 billion. That doesn't happen by accident. That happens through focus so intense it looks like obsession to people who don't understand it. Buffett closes this tribute by writing, like all who knew Roberto, I will miss him enormously. So here's my question for you. What's your Coca-Cola? What are you building? And are you going to let other people's opinions distract you from it? So let's bring this all together. Don't be a preening duck. Compare yourself to the index, not to your past self. When everyone's making money in a bull market, remember, it might just be the rain. Keep your bat on your shoulder. Wait for your pitch. You don't get called out for not swinging. Define your strike zone before markets open, then have the discipline to wait for opportunities that meet all your criteria. And pray for lower prices. If you're buying hamburgers for the next 30 years, you should want beef prices to fall. The same logic applies to stocks. If you're accumulating for decades, market crashes are your friend. These are just investment principles that Buffett shared in his 1997 letter. They re ways of thinking that separate the 90% who fail from the 10% who build lasting wealth. Buffett ended his letter with an invitation to shareholders: come to Omaha, the cradle of capitalism, and enjoy yourself. Take these ideas from Buffett's letter, test them against your own portfolio, and ask yourself, am I paddling or am I riding the tide? Here are the 5 principles we covered today from Buffett's 1997 letter. Compare to the index, not to yourself. Define your strike zone, then wait for your pitch. Want lower prices if you're a net buyer. Own your mistakes publicly and learn from them. Focus beats obsession when it's purpose-driven. If this analysis of Buffett's thinking changed how you view investing, hit that like button. Subscribe for more deep dives into the greatest investors' actual writings. No hype, no nonsense, just wisdom from the source. And drop a comment. Which of these 5 principles hit home for you? I read every comment. Remember, this video is for educational purposes only. This is not investment advice. Buffett's strategies require study, practice, and discipline. Always do your own research and never risk more than you can afford to lose.